So how do HELOC payments work and why are they different than a traditional mortgage payment? So in this video, we're going to go answer that question in a very simple way. By the way, my name is Sam Kwok, one half of the Kwok Brothers, certified financial education instructor, serial entrepreneur, and a real estate investor. And my brother and I have been teaching various financial concepts for almost a decade now, concepts that can help you make better decisions when it comes to your financial future. And by the end of this video, you're gonna be super clear on how HELOC payments work, and you're gonna feel smarter about finances after this video. Now, a HELOC, a home equity line of credit, and a mortgage are both form of a debt, and both use your home's equity as a collateral for the loan. And the one key difference that you already know about a HELOC is that it's an open-ended line of credit, meaning you can borrow from the HELOC, pay it back, and borrow any principal portion back for reuse, kind of like a credit card. Whereas with a mortgage, you're only allowed to make fixed payments every single month, and you can't necessarily borrow the money back again from your equity unless you do a cash out refinance. But the other difference that you might not know about is how the payments work and how they're each calculated. A mortgage, on one hand, uses something called a monthly interest calculation, whereas with the HELOC uses daily interest calculation. Now, both use the same basic simple interest calculation, but the time frame of which the interest calculation is applied is different. And let me show you how that works. So here I have a visual aid of a given month to demonstrate how a mortgage payment is calculated. So let's suppose we have a $10,000 mortgage balance, and I know that's not really realistic, but we're going to use a smaller number to demonstrate the concept behind the payments. So $10,000 mortgage balance, 6% interest for our mortgage. And let's say we make a $1,000 principal payment middle of the month. And what we get at the end is $9,000 ending balance. Now, the way that interest is calculated is it simply takes the $9,000 ending monthly balance times the interest rate of 6%, divide that number by 12, which 12 months in a year, that gives us the month's interest cost of $45 of total interest. So if you want to follow along, take out your calculator on your phone and do the math with me, and you'll really get how this works. So $9,000 is the ending balance, $45 total interest. Now, the reason why I have this red X here is to show you that lenders do have a cutoff period if you do want to make extra payments. So if you make extra payments, let's say here and here and here, a couple more dollars, then the lender will factor that in to calculate the final ending balance. But if you make the extra payment, let's say over here or over there, right, the lender will not factor that into the final ending balance for the month, but rather will use for next month's payment to reduce the balance then. So any payment that happens before the red X, the lender or the bank will use that towards calculation of the final ending balance. Anything afterwards will not affect this current month's balance, but rather the next or the following month. So this is how the payment works on a mortgage, just for reference. And one more note about a mortgage payment is that it includes the interest and there is a principal portion when it comes to your payment. So with most mortgages, you will pay principal and interest payment on top of the escrow, right? The homeowner insurance premium, as well as the property taxes. In most mortgages, you will pay a principal and interest portion. I'm just showing you how the interest is calculated as compared to a HELOC. Okay, so with the HELOC, it's going to be radically different. Here we have the HELOC calculation when it comes to the interest. So same starting balance of $10,000, all right, and 6% interest. So the interest rate and the starting balance is exactly the same. And let's assume we make that same exact $1,000 principal payment, just like the mortgage. And that results in the same ending balance of $9,000. Now, you can already see the difference when it comes to the HELOC is it uses daily balance as the interest calculation. So what that means is that it takes the balance for a given day, multiply the interest rate, which is 6%, divide that number by 365, which is the amount of days we have in a year, and that gives us a day's worth of interest costs that we pay for that day. So you notice at the very top, right, the first day of the month, we're paying $1.64, and that's the interest cost, assuming we have a balance of $10,000. Now, when we do make that $1,000 payment, our ending balance drops to $9,000, which subsequently affects the daily interest cost, right, to $1.47 as opposed to $1.64. So the question then becomes, does it matter when do we make the principal payment to a HELOC? The answer is yes. Because if we were to make that same $1,000 principal payment at the very beginning of the month, we would actually have a cheaper interest cost as long as we don't make any subsequent draws or we don't make any, we don't borrow more money from the HELOC for the remainder of the month. So if we were to make this $1,000 payment up here, the very first day of the month, then yeah, we would only end up with $1.47 of interest every single day, as opposed to, half of the month being $1.64. And do note that with most HELOCs, a home equity line of credit, and I say most because it's not always the case, HELOCs, the only required payments you make is interest only. So at the end of the month, what ends up happening is that the bank's going to bill you the interest portion, just the interest, for the minimum payment on the line of credit. Now, of course, you'll want to make no principal payment because that's how you actually reduce the loan balance, right? Not just making the interest payment. But in most cases, you're only required to make interest payments only with most home equity lines of credit. So what ends up happening is that at the end of the month or whenever the statement period is, the bank will add up all the interest costs, right? $1.64 and $1.47, a total sum of $46.47. Now, you'll notice that amount is definitely higher than the mortgage interest cost, right? Given the same starting and ending balance and the exact same interest rate. So it seems like the HELOC might be more expensive when it comes to the interest cost. It seems like a disadvantage. But this same disadvantage can be used as an advantage if you know how to use the HELOC properly. So I'm going to show you a different slide or a different picture. Okay. So here is a different slide where instead, I'm going to move or make myself a little smaller. There we go. Instead of making one principal payment to the HELOC in a given month, what if we decided to take our entire paycheck? That's right, our entire paycheck, and made a deposit into the HELOC. And because the HELOC, we can borrow from it whenever we want to, use it towards to pay our expenses as well. So let's say our paycheck is $5,000 and we get paid on the 1st and the 15th of the month. So on the very first day of the month, we deposit $2,500, our paycheck, into the HELOC, subsequently lowering the interest cost on a daily basis. Okay. And we do this again on the 15th day of the month, further reducing the balance of the line of credit. And therefore, our interest is down to 82 cents every single day. Now, we still need to pay for our expenses, right? We don't, we obviously need to pay for groceries, gas, you name it. So towards the end of the month, what we do is we make a lump sum draw to pay for groceries, gas, food, you name it. Now, you might be saying, Sam, this is so unrealistic. Who would ever make a one-time draw to pay for all their expenses? Like, I don't go to the grocery store once. I go to the grocery stores multiple times throughout the month. Well, what I'm trying to depict is that you could also use a credit card, for example, and use the credit card for all your expenses, gas, food, groceries. And we know that with credit cards, we don't pay interest on it right away, right? There's typically a grace period of 21 to 30 days until the next statement cycle. That's when we pay interest. And so what we can do is we can delay any kind of borrowing or draw from the line of credit and using a credit card instead to make those purchases every day. And when it comes time to pay the credit card, we completely pay it off to zero, right? Using our home equity line of credit so that we could avoid paying any interest on our credit card. This is a very efficient way of using the line of credit. By lowering the line of credit daily balance using all of our paycheck and making a one-time draw by using a credit card, right, as an advantage, we are able to pay less interest when compared to the mortgage, even though the starting balance and the ending balance and the interest rate is exactly the same as a mortgage. So knowing what we know when it comes to the HELOC payments and how it works, we can use it as an advantage to save money on interest, and it gives us the flexibility to take the money out whenever we want to. If, let's say, we're faced with an emergency or, life just throws us a curveball that we didn't expect, the HELOC gives us that flexibility. So when compared to a mortgage versus the HELOC, mortgage, we had a $45 interest cost on the monthly interest. And for HELOC, we have a $32.53, which represents a savings compared to your traditional 30-year mortgage. So that, my friend, is how the HELOC payments work. And I know I went a little bit extra to kind of give you some advantage and show you how the HELOC can work to save us more money when it comes to interest savings and how it compares with a mortgage. So if you want to learn more about HELOCs and finance and how to pay off a mortgage faster, definitely subscribe and check out some of the other videos that we have in our channel. And I'll have some resources in the video description always. So definitely check it out. Leave your thoughts and comments down below. And if you like this video, be sure to give us a thumbs up for the algorithm, and we'll see you in the next video.